Right, thanks for the introduction and the invitation. I wasn't 100% sure on the audience that I was going to be talking to, so I probably had in mind students. But we'll go through it. What I've tried to really focus in on is how do we determine what grain's worth in Australia? Because I think that lends itself to really opening up to market dynamics and how markets function. Just quickly, just so I get a sense, who in the room has heard of Clear Grain Exchange? Who in the room feels that they know what Clear Grain Exchange is? What it's trying to do? Cool. So I am going to, just to set the tone, and this is also my disclaimer, by the way, this is our sole purpose for being. We create efficient and secure markets to improve economic returns at the farm gate. Everything we do centres around this statement. It says a lot about who we are. We create efficient and secure markets. We're a technology business. You know, my background, I grew up at Lake King, obviously traded grain, advised on grain selling through deregulation of the Aussie wheat market when growers were trying to understand how to sell their grain. And then worked for the New Zealand Stock Exchange, which taught me a lot about how to run markets, operate markets. So that's the sort of background that's led me to now being the Managing Director of Clear Grain Exchange. We create efficient and secure markets. As I say, that's technology does that. That's what we create, and then it's human behaviour around that. The major beneficiary is to improve economic returns at the farm gate. We're not a buyer of grain. We're not a seller of grain. And importantly, we're not an advisor of grain. It's not our role to have a view on price. It is our role to educate market participants on how markets function and to disseminate price information to help people. And then ultimately the function of the market is to help buyers find sellers and sellers find buyers. Because that's actually quite inefficient, not just in grain, in a lot of ag markets. Righto, so I'm going to start global and then come back more local in trying to answer this question, or at least open up the conversation around how we might determine this. Map of the world. Australia sits in it. Australia, and I'll present this with a wheat lens just because it's easier. Australia is a major exporter of wheat in the world. North America is also a major supplier of wheat into the world. The US, back in the 60s and 70s, used to make up 50 to 70% of all grain supplied to the world. Now that's more like 20 to 30%. EU has been a consistent supplier to the world, similar to Australia in that it's been their contribution to world exports has been relatively flat. Obviously, it's volatile with seasons, but relatively consistent. And then South America, that's more an oilseed with Brazil, but Argentina, again, major supplier to the world, relatively consistent contribution over the long term. The newer player has been the Black Sea, Russia and Ukraine. So a lot of new supply, which has eaten into ultimately the market share from over here. That's important when we think about how do we determine the price of Australian grain. Right, let's look at the demand side. They're the major suppliers of the world. So if we dispense this, I'd like to bring it back to a simple lens. These are the traditionally large importers of grain, that area there. So the largest importers of grain traditionally and have been with consumption growing at about 1% a year. Well, recently, this has been the growth market in terms of consuming more grain, growing more at 2% plus a year. so catching up. That's the growth market. And then if we throw China in there, this has also been a newer player and quite volatile year to year in terms of when they are participating in the market. So if we have a look at that, straight away, this is giving us a fair bit of information around prices for Australian grain. We are exporting wheat into this market. Where do you think most of our wheat's going to go? If we look at that just on a geographic lens. Likely to go into here, exactly. Which, thankfully, is the growth market. Unreal. We're well positioned for that. The traditional market, where do you reckon they might be sourcing their grain from now mostly? Yep, correct. So that growth market there is shipping it across and getting it in there. So for us, these markets become more important for us when there's a production issue here. And this is why, like when we're talking to growers about this and educating on it, why is it important to know what's going on in the Black Sea? Because if they have a drought, there's a short in demand here and they've got to source it from somewhere else. And all of a sudden, we've got more demand that's going to drive our price. China, obviously, we're well positioned to be able to supply that market as well. And pending what circumstances might be at play at the time, they can be big consumers and at other times they can stand aside. But we're lucky to have them, and that's the way we should view it. Because when they come in the market, we get the price benefit. We'll focus on that rather than when they're not in the market. All right, that is an overview. Now, if we take a step back, what is global consumption doing? It's a pretty straight line, and it's a healthy line if you're a producer of grain, net producer of grain, which Australia and WA is. It's moving up. If we overlay that with how much we're producing each year over a long time, you can see the trend is the same, but it goes above and below that yellow line along the way. We're in agriculture, particularly in crops, our production is impacted by the weather, impacts that line. What do you think might be a major determinant of price basis that relationship? You think it's more driven by demand or more driven by volatility in seasonal conditions from year to year? It is driven by this difference. And what drives the difference in them? Typically the weather, the blue line, because that's the supplier. Yep. All right, so we've got good, strong fundamentals. As I say, that yellow line is really healthy. And Ross Kingwell might be able to tell you whether that's going to continue. The expectation is it is. So the difference in that line, let's look at that information. That's what I'm plotting here. This is global stocks to use. So how much grain as a percentage, how much grain we have on hand around the world. I've taken China out of this. How much grain we have on hand that's available to the world versus how quickly we're consuming it. So if it's at that level, we have 20% of our consumption for the year, estimated consumption for the year, we had on hand at that time. Meaning if we didn't produce any more grain, we would run out in 20% of 12. 3 months. All right, and I'll just look at more recently. That's just a line to give us a bit of a reference across the low point, stocks to use. And at the moment, global wheat stocks are doing that. Now, if we've got less stocks on hand versus how quickly we're consuming it, do you think prices are likely to be higher or lower? If that is heading down, do you think that's going to push global prices higher or lower? Higher, dead right, because we've got less buffer in the system. We're more susceptible to a weather event that causes that volatility in the blue line. That's what's happening now. So let's look at a global price benchmark. Is everyone in the room, how many people in the room are familiar with Chicago Board of Trade futures? So Chicago Board of Trade futures, US based, has been a traditional benchmark of what global wheat values are trading at. Why? Because as we went through earlier, the US used to be and it still is, one of the major suppliers of wheat in the world. Now the reality is their impact as being a supplier in the world has shrunk, so which will have implications on how relevant this line is now to the value of Aussie wheat. But as one benchmark, this is one global benchmark, that's what's happening. Now look what's happening more recently. Does that seem to line up with the slide I just had up previously? So what's going on? It's because wheat is substitutable. A lot of wheat, oh hang on, before we move on to that point. So Chicago Board of Trade has been a benchmark for global wheat values, right, as a starting point for those reasons I've outlined. Now what I'm plotting here is Kansas Board of Trade wheat futures. Now Kansas Board of Trade wheat futures is based off a higher quality wheat, a higher protein wheat. And you can see that actually they trade in a similar sort of direction, but the spread between them changes. Now just out of interest, the white line quality is more akin to our APW benchmark wheat that we grow here in Australia. The blue line is more akin to our ASW wheat that we grow here in Australia, which is a certain quality. And what I lay here is Matif, which is European wheat futures, more similar to an ASW type quality, but European, based out of Europe. Why is that important? Because of that map I showed you earlier on. That is a major supplier and trader of grains. So again, you can see here, in fact, I'll go one more. And this is a Black Sea price, which ended there because it stopped trading. And this is, so there's 3 points I want you to take away from this. One is CBOT is not the only benchmark of global wheat prices. And you can see why we need to have a broader lens than just Chicago Board of Trade, which has been a real critical focus, for the grain industry in the past. Traders use it as a hedging tool. That is why our prices are partly determined by that. It's a good risk measure, but you can see that it's becoming less relevant, and actually the correlation to Australian prices has become less over time. And now hopefully you understand the reasons why. So these other prices become important. Around
the differentials collapsed at November 20.
Yeah, so, and there's reasons for that around supply and demand. We're going to keep going through that, mate, with numerous reasons. So the second point is they generally move together, but they're different, which is what Ben has just pointed out. And actually the relationship between them moves. There's risk there. Why is that? Because there's a lot of reasons for it. Supply and demand in local areas. So you can see the blue line is going to be impacted by US specific factors as well as global factors. The green line is going to be impacted by EU specific factors as well as global factors. So there's a bent in all of them. There's a bias in all of them. That's why we can't focus on one. How does Australia... Now, the Black Sea is a newer market, and market participants tried to create a price benchmark that everybody could see to determine where Black Sea, to be an indicator for Black Sea prices. And it was relatively successful for a while until there. So the point is, it's hard to create these. It is a hard job. This got hammered into me when I was at New Zealand Stock Exchange. Creating markets, it's a long-term journey. You've got to build the liquidity and the people using it. And the reason they're going to use it is if they understand the why. And I'm going to spend a bit more time on that shortly. Creating more efficient markets, the more of these that can provide us with a price indication that we can then manage risk off and determine our own price, the better the market dynamic for everyone. So why is it going down though when we thought it should be going up, basis the wheat stocks? It's because wheat is substitutable and it can be substituted by corn. And if I was to distill it down into one major driver for the purpose of this lecture, because I've got a certain amount of time, this is same chart but for corn. Global stocks used for corn, and you can see more recently it's started to improve. Now, a lot of that improvement is based around what they expect to happen in the US. This is the same chart, but now just US rather than global stocks to use. US, along with Brazil, are the two major exporters of corn in the world by a long way. And look at the significant increase they're expecting there. Now, the point is, another point there, is that the US corn crop hasn't even been planted yet. That expectation, that's an expectation of the market, that is not fact. And we know what it takes to grow crops. So that hasn't happened yet. It is all based around, based on their estimates, achieving record corn yields in the US. So pretty strong assumptions for the market to be trading around, right? Now, but that's a really important point, is that prices are impacted by market or participants' expectations. The market is actually trading with a future lens. It rarely trades in the here and now unless there's a change in an event. Typically, they're trying to predict what's going to happen in the future. And I remember when I was trading, I learnt that lesson. So I was like, this isn't, but the market is future looking. Right, now just going on to that concept of the market price is partly determined by behaviour and expectation, not necessarily just fundamentals. This chart shows the net position of fund managers in the Chicago Board of Trade corn market, which is the most liquid, one of the most liquid markets in the world. So if that line is below zero, it means that the fund managers, so these are funds that aren't there to trade physical grain. They're there to take a position and speculate on the movement of price. If their net position in the market is below zero, that means they're net sold in the market. It means they expect the price to keep going lower because they make money out of the market continuing to go down. If it's above, vice versa. Their expectation is it's going up because they make money by the market going up. What do we have right now? It is the biggest net short position they've ever had in the market. So their convictions around the market is going to keep going down is as strong as it's ever been. Now, as we know, there's more and more money in the world every year, and you can see that in that the volatility in this line has only got wider. More money going into these markets has a bigger impact on the price of these markets. It means the highs of our market go higher than they possibly should, and they go lower than they possibly should. We may well be in one of those positions now. Because the other thing that means is there's possibly not a lot of extra horsepower for speculators to add to this position. meaning they can't keep selling the market down. They're either going to hold that position and keep making money out of it, but if something in the market changes their view and they think the market's going to go up, they need to get out of that position, which means they buy it back, and it creates more demand and actually impacts price. So perception, behaviours of market participants impact price. Same chart, but this is for soft red winter wheat. Still bearish, but more neutral stance, what it has been. Again, a lot of those crops haven't been planted yet. Soft red winter has, but it's been under dormancy, still has the spring to get through. None of these crops get harvested until sort of July, August. Fair way to go. Market has already taken a lot of risk out of price around production. The market expects we're going to grow more crops this year. And that's a big impactor of price. What is Australian grain worth? Let's bring it back more to Australia now. There we are, sitting in the global landscape. We're impacted by global prices and what's happening. Let's look at Australia specifically. WA and South Australia are net exporters of grain. They will always have a surplus of grain. I shouldn't say they will always have a surplus of grain. That may well change in 30 or 40 years. But what I mean by that is the amount of grain that they consume locally here is quite low, 10% or so, 10 to 20%, depending on how much we produce versus how much we actually produce, which so means it needs to find markets offshore. If we flip that to the east, in an average year, they are net exporters of grain. However, the percentage that goes out in an average year is more like 40%, rather than over here where it's 80%. So that means if they have a drought, sometimes they actually are short on grain. They need to buy it in. Where do you reckon the most logical place is if these areas need grain? Where do you reckon they're going to buy it from? Other Australian states. It's not likely to come to the US unless it's really specific quality. So, in that circumstance, this is trading at import parity. That continues to trade at export parity. Even in a drought, that still needs to be around export parity. There might be some premium in it because some consumers, thankfully, are somewhat reliant on Aussie grain. We need to maintain that. But we've got export and import. So if I was to do this, and this is a chart that I remember would have been one of the lectures when I was here at UWA. But if we had price and over time and we had import parity, which we know doesn't stay in a flat line over time, that's a moving line. But just for the purpose of theory, where should Aussie grain prices trade on that chart? Somewhere in between those two lines. Exactly right. And in WA and South Australia, it's always going to be closer to this line. In the east, it's going to be sometimes up at that line, sometimes down at this line. So the eastern states growers actually have, the way I would describe it, a natural subsidy in a drought. Because the cost of moving grain from here around to here has been around $120 a tonne. And guess what? Prices, when we've had droughts over here versus here, might be trading at 300 here. And where do you reckon they're trading over here? That's trading at 300. About 420. And often it'll end up being about 440, just to trade a bit of a premium. But you get it, right? Import-export parity is hugely important for Aussie grain prices. That's where we're trading. Now, the last 2 years, not now, but the 2 years prior to this, the reality is Aussie grain prices have been trading down here, which shouldn't happen. And we'll touch a bit on why that might have happened. What is Australia's export parity price? So if I was to ask you guys that, basis the knowledge that you've what we've just been through, what would be the best way to determine that? Because that would be a good starting point for us to understand what our grain's worth, wouldn't it? How would we determine that?
Chicago Board of Trade adjusted for easier or something like that.
That's one potential, and that has been a common mechanism in the past. But what I've tried to do here is challenge that thinking, because you could do the same against Matif, you could do the same against Kansas, you could do the same against Black Sea, but even those are still indicative and not necessarily reflecting the physical market. So what might be a better way to determine that? Import market, how do you determine that? So what you're saying there is actual traded prices into Indonesia. That's gold. You know, if we can, so the reality is that information is hard to get hold of. Why? Because it's binary between two individual parties. So in some parts of the world, that information's quite open. So Saudi Arabia, Egypt, they publish their import prices. They hold tenders, it's very public, they publish that. We can use that as a benchmark, and that's still worthwhile to make that conversion back, which is exactly what you're saying. But we know that actually our grain's typically not moving into that. So the best way to determine that would be what's trading into Indonesia, what's trading into the Philippines. And there are parties out there that are trying to do that. Platts and Argus, that's sort of their area. But they also try to do that at the Black Sea. See what happens. It's hard for that to happen, to make happen. But that is the goal. If I was to try to change one thing in Australian grain, it would be to have better transparency or line of sight on those transactions. Because I think that has huge implications and trickle-down benefits to how the market operates within Australia. All right, let's keep going back even further to within Australia and how the market functions within Australia. What I'm depicting here is how the Australian grain market operates today. So now we're in the WA grower area. A grower harvests their crop and stores it in a silo, wherever that might be. It might be in CBH, it might be on their farm, wherever. At that point, buyers don't know what the quality is, what the location of that grain is, what the quality is, and importantly, what price the grower wants for that grain. It is actually a hard job for buyers to find that grain and buy that grain. Now, the outcome of that is that there ends up being just a handful of buyers buying the majority of grain from Australian growers. That's the outcome of that non-transparency. And nowhere more so than in WA. One buyer typically buys 40 to 50% of the grain, possibly 40 to 60% of the grain. Spread that number to 2, you might be at 70%. Spread that number to 5 or 6, and you'd be at the majority of grain in Western Australia is bought by that number of buyers. Sound about right for those that are in the market? Yes, I'm getting head nods. Right. And the outcome of that is what I'm depicting here is, so how do these guys buy grain? They put a published price out there. They say, this is what we think the grain's worth today. This is what we're buying at. And there are services out there that try and collect all that information out, line it all up. And what I'm depicting on this next slide is one of those services who line all that up, and this is the best price for A grade of wheat out of Kwinana. ASW wheat out of Kwinana. This is the price, the best price that's been put out by the buyers that are active in buying grain off growers. Is that the price? Is that what wheat is worth in Australia, that has typically been the price discovery for growers, that line. All right, how could the market function if growers offered their grain for sale? Now, this is what Clear Grain Exchange is focused on, by the way. But if growers could offer their grain for sale at a price they want, or at a term, the buyer can now see what the quality is, where it's located, how much is for sale, and what price the seller is at. Just by doing that, you've made the buyer's job a whole lot easier to buy that grain. They can see it, they can bid for it, they can grab it. And because you've made that buyer's job easier to buy grain, it encourages more buyers to come in to try and buy that grain. The reality is these buyers have always existed. There's been more than a handful of buyers buying West Australian grain. They just haven't necessarily been able to buy it off the grower. And often the price, so where do you think they have bought it? How have they bought WA grain? Off these guys. And often the price trading between here is different to the price trading here. So all the exchange is trying to do is make it easier for all of those guys to buy it, rather than two-tiered market, one price. And growers can control that by offering. Now, if we're bringing more counterparties into the market, we need to make sure growers are protected. We make sure we settle everything. So this is the exchange ethos. We make sure every transaction is cleared or settled to protect parties within that. And actually what it also creates is anonymity, which is also critical to a market functioning. So anonymity, buyer never knows the seller never knows the buyer, grower can set their price, nobody ever knows it's Nathan Cattle's price up there. They can have confidence in participating in that. That's important. So that's secure settlement. And the other thing there is more efficient in terms of collecting endpoint royalties, like critical levies, critical things that underpins our industry's continual development are made more efficient and actually done by this. And now our next phase of growth is more doing that for grain that's stored outside of warehouse systems. That's been missed. So yeah, that's, by creating a more efficient match, but helping buyers find sellers and sellers find buyers creates value in the market. Now, all well and good to say that. Was some evidence. Just last year, we had 55 different buyers buy West Australian grain through CGX. Now, the point is there were more than that were actually searching for grain, but couldn't find the quality they were after in the location they were after or at a price they could match. So there's more appetite than that, but that's just one little data point of evidence. It works. Let's make more efficient markets. Another bit of evidence, I'll come back to this line. That has been the price discovery that growers have been benchmarking on. Let's overlay that with actual trades through the exchange, actual traded prices of those dots. Now, the point is, had that grower or growers, there might be multiple trades behind that dot, not offered their grain on that day or had it out there at a $380 a tonne price, we may never have known that a buyer was out there willing to pay that price. That's the power of creating a more efficient market. Because if they were waiting for that line to reach their $380 a tonne target, they would never have sold it. They'd still have it. So by that simple act of growers having a say in price, getting it out there on the front foot, it creates so much value for the industry. And that's just more, same chart, more commodities. The interesting part here is like oats. Often the discrepancy might be $40 a tonne or even $90 a tonne we've had, between the line that growers might think their grain's worth versus where it actually trades. And for the more liquid ones like an ASW or an APW, the average is more like $10 to $15 a tonne difference. But you get the idea. So the message to take out of that is growers have a say in price. Often you hear from the industry that, particularly from growers, we're price takers. That's a terminology I feel the industry can get away from. Now, we are impacted by the global price. We've just been through that. However, it is also around behaviours within the market that determine our price. So if I went back to that chart, and I didn't do it here, but if we went back to that import parity and export parity chart, and the point I made that there was 2 years there where prices in Australia were trading well below export parity. Why was that happening? One answer to that is because growers were selling at those prices. You can't expect a buyer to bid up their price if they're not going. You can't expect them to pay more than they have to buy the grain. So if growers or their agents, the industry on the sell side, had better knowledge of how markets function, I suspect that value prices would not necessarily have been down there. So that's the opportunity for universities and, you know, people that are coming into our industry. Right, back to here. So what is Australian grain worth? Chicago Board of Wheat, we could use that as a benchmark maybe. We could do our conversions. There's the APW published bid out of Kwinana. You can see that varies. That's a published bid, and we know it trades at better prices than that. So what is Australian grain worth? Which line of these do we take? The best determinant to determine export parity would be traded values into here, or traded values free on board off here, or here for that matter. That would be absolute gold to help put into this equation to determine what grade's worth, because ultimately, hopefully what's becoming clear is location impacts price, supply and demand in each one of those impacts price. We've got a number of indexes and benchmarks to use to help us manage that risk, to determine that. We know how this should function. We know that also those markets out of there are impacted by speculators and participants, which is also happening. By the way, we've tried to get a futures market going based off this. We've also tried to get a futures market based on this side. Both relatively unsuccessful, which I think the market would be better if they were successful. Getting some clarity there. We're keen to keep promoting that and educating around that. We see that as a role of Clear Grain Exchange. But yeah, prices are impacted by location. Prices are impacted by quality. You've got quality differentials. Prices are impacted by commodities. If corn's going to have a big crop, that's going to drag wheat down with it because there's some substitute there. In Australia, if feed barley comes off, that's going to drag wheat with it, or vice versa, because they substitute. You've got time, so the market's trading expectations, and you'll have differences in prices based on when they expect the delivery to come. And ultimately, that information is hard to get and would benefit us massively in determining it. But the point I'd like to make is that we've got improvement to be made in this industry, and the action that we would love to see evolve and we're focused on over the next couple of years, I think, shouldn't be a too daunting a task. Growers could be solely focused on determining what their grain is worth. I've just outlined some of the things that impact it, and ultimately you determine an equation. And at different points in time, one of those measures is going to be more important than others. But if we can get growers and our agents and our advisors and our helpers focused on trying to work out what the grain's worth and offering it, rather than spending so much energy on doing this or emailing, trying to find a bid and haggling over the price, which ultimately creates more inefficiency, because how do you know you're haggling with the buyer with the highest willingness to pay? Send the price signal out from the offer side that helps determine the market value. That's the behavioural change that I think we can achieve in the industry. And I reckon that's hugely exciting for industry in general, because the motivation for like students coming out of UWA, these sort of things, we haven't worked it all out yet. Things aren't broken. Like, we've done a pretty good job over the journey of improving things, but there's still, in terms of how markets operate, how we're producing crops, but there's still so much gain to be had, right? So that's the, you know, and I think if we've got good, smart people that are motivated and care about what they're trying to do, there's still heaps of upside and value creation to be had. That's all I got. Thank you. Selling which way?
Through you guys, like the logistical disadvantage, like rather than going through CH.
So two separate. So CBH's core function is to store grain and move it through the supply chain. Growers that use the CBH system to store their grain and use that service can offer that grain for sale on CGX. Yeah, that's right. They're complementary. Things. So we like. I'm a big supporter of the CBH system. So I think that's a good thing. I think it makes sense for growers to own that sort of infrastructure. It's a utility. It should be viewed that way. It's a lot of, like, the more efficient we can make movement of storing grain and moving it, and that's how we know we grow more than we consume here. We need to get it to market, to value add it, to realise the value. It makes sense to me for growers to own that infrastructure that's critical to their business.
If I'm a participant in the market, what level of information about depth and price on either? So you're the marketplace. If I participate, what level of information can I see? So if I'm trading on some other market, I can see the depth, I can see what's there, I can see how things are going to move and what will happen, like how much I'll put in, I know how much. Yeah, I can see everything's fairly transparent, and extremely fast. Settlements within approximately, not settlement, but in terms of trade moving, but the trade notification for processing is pretty.
Yeah.
What's the grower's experience? So the information, what do they see?
So the way a grower, so I'll answer that in two ways. So I'll talk about how the transaction happens for the majority of transactions now, and then I'll talk about, I think your question's more focused around the clear grain exchange experience as well. So how grain transacts now is typically growers are waiting and watching that line that I put up. You know, the best published bid. Is it up today? Okay, I'm a seller at 400. That line, the bids that are coming out, and often I'll be receiving that bid from numerous. So I might be receiving 5 text messages, different buyers. I might be looking at that. But I'm sitting and waiting. That's 370. Oh, it's not close enough to my target. I'll wait. It's at 380. Oh, it's getting closer. I'll wait. It's at 390. All the while, buyers can't see what these guys are targeting. It's at 390. Oh, getting pretty close. Maybe I should engage. Bugger, it's too hard. Drops back to 380. Oh, bugger, I should have engaged. Okay, now it's back up at 395. Okay, I'm on. And now I'm ringing or I'm emailing. I'm at 390. I'm a seller at 400. Can you get your bid up to that? Buyer says, no, mate, we're sticking at 395. Next one. Okay, I'll get up to 398. It's not 400. Okay, next one. No, best bid I could get was 398. Okay, I'm a seller at that. I'll go back to him. Mate, that bid was an hour ago. We got filled. Price is now back to 395. Oh, going back to the thing. You know, like there's an inherent, like how clunky is that? And how, like the price is moving, right? So to grab that, it's a clunky process, it's time consuming. And as a result, a lot of growers hate selling grain. They don't find it a fun, enjoyable act. I'll get someone else to do it, which there's a lot of good operators that do that and help advice. But I think rather than them doing that on their behalf, they could be more looking at value add in trying to determine what price is about. Because then at that point, to get the deal done, that's often verbally binding contract. 1,000 tonne, $400 a tonne, $400,000 value, verbally binding per Grain Trade Australia, which is a testament to our industry. We've got a good governance body which underpins the validity of the contracts. Being held up, the dispute resolution process, very thorough, being held up at the Supreme Court. You can't question it, which underpins the integrity of contracts, but it's verbally binding, reliant on both parties jotting down information, one sharing it. Oh, hang on, that doesn't look right. That's not what we discussed, etc. Okay, assuming that's all okay, now the grower transfers the grain to the buyer and waits for payment as an unsecured creditor. And sometimes those terms, so the industry has tried to bring those payment terms back to the point of where it might be 2 days. But back 10 years ago, it used to be sort of 30 days end of month. So sometimes 60 days, depending on the timing, where the grower is an unsecured creditor. And I would argue, even if you've got short payment terms, the risk is still the same. The duration of the risk is shorter, but you're still an unsecured creditor for that period, right? So what happens there? Growers rightfully determine which counterparties they're comfortable dealing with, which shrinks the buyer pool. So you can see these inefficiencies, right? So with, say, a clear grain exchange offering, growers can offer, all their focus, rather than all of that, can be just determining what price they want and get it up there, buyers. To your point specifically, that's how a market, which has been born from the New Zealand Stock Exchange days, operates like a stock market. Like that's what their deep knowledge was on. How to run a market that's independent, not biased. That's why I started with saying we're not a buyer, we're not a seller, we're not an advisor of grain. You can't be one of those to run an independent exchange because straight away you have a view on price. And you can't do that if you're trying to determine the price, the real market price, which is what an efficient market's trying to do. Now, to run an efficient market, it needs to be real time. You need to see depth of bids, depth of offers. It needs to have market open hours, market close hours. The opening hours of that, the close hours of that need to be random, so it can't be manipulated in any way. First in, first out logic. There's a list of logic in the stack, which is where our depth of knowledge comes in. It needs to be anonymous. It needs to be fully secure, to give that confidence in it. Like all of those things make up what is an independent market, and that's what creates value. And that has been on us to determine that. Sorry?
They can see other sellers.
They can see other sellers offering. They can see where the buyers are bidding. You can see all of that. Similar to if you were jumping in, the way to think of it is like the ASX, right? If you're buying Commonwealth Bank shares, you can see the offer board, you can see the bid board, you can see the trades going through it. Sorry?
Yeah, so we have Julian from online. He said there's so many questions to ask you. So Julian, go ahead.
May I jump in? May I jump in?
Yeah.
I think you need to.
Thank you. Thanks, Nathan. Can you hear me okay?
No.
Did you have a question while we were waiting?
Yeah, can I? Sure. So for me, one of the great advantages of the grain exchange going forward is the whole of industry benefit. And what I mean by that is we already know that there's a lot of, say, feed grain that gets exchange purchased, and the import royalties on those varieties don't go back to the plant breeder. Sometimes the R&D levies aren't paid. So for me, one of the advantages to the industry by using clear grain exchange is that all those legitimate revenue flows go back to better the future of the grains industry. Because at the moment, there's a lot of revenue leakage that occurs in different jurisdictions, and so you actually get underinvestment in certain.
Exactly. Like, I mean, seed companies, we should be growing more feed varieties. My view. I mean, that's been a big part of the growth market into Asia at the moment is feed grains. And, you know, like when I was trading in Victoria, it was in the feed industry. It's a fantastic industry, by the way. Relative values between commodities, it was awesome. Like learning, logistics. But we'd be buying ASW wheat because we couldn't buy it. There was not enough. Like, we don't produce enough feed grain for our domestic consumption, let alone the growing export market. And possibly there's a yield benefit there, lower cost of production there for growers, and it's just been off radar. And part of that has been because seed companies haven't been able to monetize those because of all the leakage, particularly for those grades typically going into direct to end user outside of the warehouse system. That's where the majority of the leakage happens. And mate, that's sort of the next phase for us is what we're trying to solve for and contribute towards. Because to date, Clear Grain Exchange has been really focused on grain in warehouse, like a CBH or a Viterra or a Grain Corp or, you know, or like Jack, you can tell me, but I think it's 26 or 28 different storage providers around Australia is where CGX operates. They serve a really critical function on quality, weighing, storing it in a title, and at that point we know Ross Kingwell has just delivered 42.76 tonne of APW quality wheat, which is electronically title transferable. Great function for the industry. But obviously there's more and more grain getting stored on farm and going direct to an end user, and that's often where the majority of that leakage is, and often that's more bent towards feed grains. So then, as you say, that trickles all the way back to seed company behaviours. And we probably could be investing a lot more in feed grains, and that'd probably be a benefit for growers, or at least give them those options more, you know, pending their enterprise. Yeah.
So may I ask the questions on Julian's behalf? He had 2 questions, but because of our time, so I will ask only one of them. So when he asked where the data came from for the fund manager short or long, if they are short, someone else must of course be long. Your argument seems to rely on fund manager being wiser than those on the other side.
Well, that's true. That's fair. So that data is reported from the CME who run the markets. So they distinguish between, and I think Ross or someone else in the room might remember the history around this. But I can't remember when that was. It ended up getting mandated, I think, because they were having a bigger and bigger influence on the price in the market. So they needed to start to report that information. But that's real data. But you're right. To some extent, like every position has to have another one, but it's just it's just another data point, I think, like the view of those, because often somebody who's long that's taking that opposite position is there to trade physical grain. So they're actually hedging a position. So they might be short and then taking a long position in Chicago to hedge that without taking a view on, they need to trade grain regardless if prices are going up or down. So they're the ones sitting on the other side. Whereas the reason we're looking at those guys is because they're only in the market to make money over the direction of the market. So hopefully that explains.
Yeah.
True.
So, Julian, I will pass the second questions to Nathan later on and after the seminar. Okay, thank you very much, because I think there's still questions.
I think we got one more.
But we don't have that much time. This means that we are very excited about what you have presented and we want to discuss more. Thank you very much for being here with us. And we hope that our collaboration with you and also Clear Grain Exchange will be further strengthened with more learning exchange and also collaborations and research on grain. Thank you.